Hi Joshua, it's good to see you again. Hope you are doing well. I'm Shivam Suri from Suri Financial Solutions. Before we start with our today's meeting, I would like to thank you for giving me an opportunity to suggest a few changes to your current portfolio. Before we proceed to any recommendations, I would like to quickly go through your current portfolio. In your earlier meeting, you told us that you have the below mentioned portfolio, which is 16% of your portfolio is invested in RBC Canadian T-bill Fund A, 36% of your portfolio is in Sun Life MFS Canadian Bond A, 26% of your portfolio is in Renaissance Canadian All Cap Equity. Then you have 16% of your portfolio in Council US Growth Series A, and the remaining 6% of your portfolio in Fidelity International Growth Series A. In that meeting, I also requested you to fill a questionnaire with some basic questions such as what is the primary purpose of your portfolio? What type of portfolio would you like to own? How long would you be willing to wait for your investments to regain any lost value? How long will you continue to remain invested before you will begin withdrawing a significant portion from your investment portfolio? These questions were to determine what type of an investor you are in order to build a portfolio that suits your investment needs. Based on the questionnaire, I have come to know that you're a balanced growth investor. Balanced growth is certainly a simple but effective portfolio that invests in developed stock markets of the world with risk managed by Canadian bonds. This model can typically deliver returns that equal an all stock portfolio with less risk or volatility. It can deliver better risk adjusted returns. It's also in the sweet spot for people who are often best served with generous spot and generous growth and a modest amount of bonds for support. Those bonds are there to address that sequence of returns risk that will arise when the stock markets go in the tank. So based on the on your profile, I have created an investment portfolio which looks something like this. Cash component will be 0%, fixed income would be 40%, Canadian equity will be 20%, then we'll invest 20% in US equity and the remaining 20% in international equity. By investing 40% in fixed income, you will adopt a defensive approach to ensure a steady income and security. On the other hand, investing 60% in equities, whether they are Canadian, US, or foreign developed, that will give you some exposure to growth, hence achieving a combined total balance. Now, moving on to in order to achieve a requisite portfolio, we must do a certain trade here. We will be building your portfolio from scratch to achieve optimal results and returns. Hence, we'll be selling all your current holdings and buying the new ones. This means that you will be investing in the following manner. You will be investing $47,768.40 in Vanguard Canadian Aggregate Bond ETF, the same amount in Vanguard US Aggregate Bond ETF, similar amount in Fidelity Greater Canada Series F, RBC Quant US Dividend Leaders ETF, and also an HSBC European Manager. Once we are done with the recommended buying and selling, your portfolio will look like this. If you notice here, 40% is invested in fixed income and the rest in equities. The cash component we have kept as 0%, but I still went ahead and provided you with a money market fund to keep some liquid cash if you want in case of any emergency or in case of your RRSP in the future. I didn't recommend any cash component because looking at your case, I don't think you need any liquid cash at this time because you and your wife both are working at the present. However, if you still feel that there might be something in the future that you would need cash, I will say go ahead and keep your cash in CI high interest saving class P. Apart from that, your final recommended balanced growth portfolio looks like this. And now it's time to look at your investments in a little bit more detail. Here we have done an analysis of your portfolio based on the investments made in each sector in different parts of the world. Talking about sectoral diversification, you can clearly see your current portfolio leans towards sensitivities, about 48%, and then about 45% in cyclicals and 7% in defensives. Moreover, the current portfolio weighs heavily in financials, that is 25%, technology 15%, and industrials 15%. Similar percentage in energy also, which is 15% too. Our goal was to increase your investment in defensive, focusing more on healthcare and consumer defensive. Also, we wanted you to reduce your investment in sensitives and cyclical by a small amount. And as you can clearly see, the portfolio here rightly achieves your goal. The investment has increased to 22% in defensive and decreased by 41% and 37% respectively in sensitives and cyclical. Now, coming to your regional diversification, we have focused your regional distribution towards more of the outside area of Canada and US, that is specifically Greater Europe area, which is 34% of the total uh, distribution. We feel like there's some untapped potential here, and we need to take the advantage of that. To match your investor profile, we have started to diversify and expand towards these international markets since they come with great risk and great returns. So, higher the risk, higher the return, as they say. Hence, we have reduced your proportion of American region from 88% to 65% as per the goal. Now let's talk about your portfolio in terms of your performance. As per the proposed portfolio, it has outperformed the benchmark throughout, as we can clearly see in the graph. So we are on the right track with regards to your investments. I know by looking at the comparison, it sure seems like that your current portfolio is higher than the compared one to the recommended one. But I would like to tell you that the current portfolio is not in line with the investor profile. It is quite unfair to compare two portfolios solely based on their performance. That is because there is a disparity between the available data. The current portfolio is based on 10 years of data, while the proposed portfolio is based on only 3 years of data. Despite that, if you can compare the figures of net returns, the proposed portfolio is much better. For instance, looking at the 1 year net return, the current portfolio is negative by 4.82%, whereas the proposed portfolio is down by 3.83% when we compare the portfolio return net and the benchmark return. Similarly, the 3 year net returns. In the 3 years net return, the current portfolio is negative by 1.13%, whereas the proposed portfolio is negative by just 0.44%. Your proposed portfolio is a perfect match because it is in line with your investor and risk profile, and furthermore, it gives you appropriate exposure to the right sectors and regions, as we saw in the previous slide. We saw in the previous slide that why the proposed portfolio is the most suitable one for you and how it is better in terms of performance and diversification. However, you might be concerned, what if the market is bare, and it is not performing to the best potential? In that case, there might be some ups and downs in the reality, right? So facing a bear market is not that easy. And if you don't have the right kind of direction, you can lead into, there can be mishaps. So that's why we are here for you. We will turn the threat into an opportunity by rebalancing your portfolio. Rebalancing means adjusting your asset allocation to the benchmarks that we have decided as per your investor profile. Let me show you how we'll rebalance your portfolio by looking at this hypothetical bear market situation. Suppose the value of your portfolios goes down by following percentages. The Vanguard Canadian Aggregate Bond ETF, let's suppose, goes down by 10%. The Vanguard US Aggregate Bond ETF goes down by 20%. Fidelity Greater Canada Series F goes down by 15%. RBC Quant US Dividend Leaders ETF goes down by 10%. And finally, HSBC European Manager goes down by 15%. Now let's see how we'll manage our portfolio and rebalance in this situation. This table shows that how your asset allocation will be after the bear market. As you can clearly see, the fixed income component has dropped to 39.5%, but we need it to be at 40%. So we will invest and sell around $2,000 more in Vanguard Canadian Aggregate Bond ETF. Similarly, we need to buy Vanguard US Aggregate Bond ETF by amount $3,000. The US equity has increased by 1%. So we'll sell RBC Quant US Dividend Leaders ETF by around $2,000. Lastly, the Canadian and international equity, the rebalance portfolio has decreased by 0.25%. Hence, we will need to buy each of them around $500. This will bring the portfolio back to where it was before the bear market condition. This is what we call rebalancing. Bear markets give an opportunity to buy low and sell high. Now we'll be discussing our fee structure. We are fee-based advisors and we'll charge our clients 1% of their total assets that we manage annually, and for the same, you will be charged quarterly. Our fee would cover not only managing your portfolio, but also managing your investments, rebalancing your portfolio, just like we did earlier. Further, we will also take care of your retirement planning to make sure your financial plans are in line with your retirement goals. Besides this, we would also cover insurance, tax, estate, and trust planning. We would hold our calls monthly to review your financial plan to ensure everything is covered. However, do not wait for our monthly catch ups. In case of any unforeseen circumstances, feel free to reach out to us whenever required. In a nutshell, this table should be your final portfolio going forward once you acknowledge the same. Once again, thank you so much for giving me the opportunity. And once again, I would like to reiterate that do not hesitate to reach out to us in case of any questions and doubts. Looking forward to connecting with you soon, and have a great day and rest of your week. Thank you.